Today we're talking about the wild west of analyst price targets, upgrades, downgrades, reiterations, buys, sells, all of that good stuff, why it makes no sense and why you should not be using this for your own trading and investing. So hear me out. You may notice that stocks tend to move off of upgrades, downgrades, and price targets. And that could definitely be a reason why a stock moves on a given day. And we've seen the time where penny stocks get a big price target upgrade that they're sitting at $1 and upgraded to $5 by some random analyst from some random company. And these stocks can go on 100%, 200%, 300% runs. And obviously we've seen that when the market was super, super hot, but it could still happen. And downgrades the exact same. But there's a big problem. Actually, there's many problems. And in this video, I want to walk you through why these are absolutely stupid and they should not be a core or fundamental piece to your investing. They could be added to a trading strategy based off of a big move up or down. However, even that could get you caught up on the wrong side of a trade. So I want to dive through a couple of examples to kind of show you guys. First, I want to take a look at this right here. This actually came out on May 2nd. Amazon shares are down 1.5% pre-market after Webush removes stock from the best ideas list. Okay, cool. Now, is this why the stock was down pre-market? There could be a lot of reasons why, right? It was a Monday morning. But what I think is very, very funny in this one example, which we're going to dive through a couple more, is this right here. This is one of the more recent price targets we have from analyst Michael Pachter, who has currently a 3,950 target, which was lowered from 4,300 on Amazon. And this is funny because this actually came out on late October of last year, which is some time away. But if that target hasn't been revised, they come out with this right here and they remove it from their best ideas. This current move would imply about a 50+% move from where it's at right now on a large cap on Amazon, a company that I don't think a lot of us believe will be gone in 5 to 10 years. It's the exact opposite, I think, of when it comes down to actually good investing. When it comes down to good investing, you want to be looking at companies, and obviously Amazon, a lot of stocks were inflated. Okay, a lot of stocks were inflated. That's the whole story with a lot of stocks, a lot of companies out there as it is. But when stocks start to make substantial pullbacks, in Amazon, for example, in this case, and it pulls back from the highs that it hit to where it is now, if we take a look at that, you're talking about a 37% pullback. And you're talking about a stock and a company that you can now get at a substantially better deal than what you could have done literally 6 months ago. Yet we can remove these stocks from the best idea list and influence a lot of traders and investors who may not have a lot of experience because it's now no longer on the best idea list, but still have price targets that make no sense. On top of that, we have the whole Goldman Sachs saga with Twitter, which this is absolutely comical. If you don't know what this is, let me tell you. So take a look at this. Elon Musk comes out a couple weeks ago and says, hey, willing to buy Twitter for $54.20 per share. Meanwhile, Goldman Sachs is going back and forth with Twitter and recommends that they don't take the deal. It is not enough. Okay, fine. That's what they think. It's not enough. They think it should be valued higher. Fair. Yet they have a price target on Twitter, a 12-month price target, a 1-year price target at the time of $30 per share. And this was when Twitter was at $37, 38 bucks almost, indicating roughly 20% downside. Yet when we have an offer to buy the stock or buy the company, right, for substantially higher than where it's currently valued, that wasn't a good deal. It should be higher. Makes absolutely no sense. Then you jump over to stocks like Facebook or Meta these days, and you look at the recent price targets on this thing, and there is just a boatload to go off of here. And so for most investors, they have absolutely no idea what to make of this. You've got random companies, many of which you've probably never heard of, some of which you've heard of, some of which may have some names that are associated, like Morgan Stanley. I guess Webush you've seen before, Jeffries I've seen many times, Piper Sandler. There's a couple on here that have some sort of authority, I guess, in the space, in the investing community. But you kind of have numbers that are wild, right? You have 212s, which Facebook's currently trading around 212. You got 300s, you got 370s. You go here and you look at this guy, Ross Sandler, who has, literally a 5-star rating almost, and he's got a 370, and you think, oh, let me believe him, it's a 75% upside. And then you got people who are saying holds, and you got people, if you keep scrolling down, there's some sells. There's too much. There is honestly too much. So what's the recommendation from this? Well, there's actually a lot of stuff you can take away from this. That's actually good. The problem is that when these numbers come out, the moves already happened. A lot of these get reiterated, or these new price targets get updated after earnings reports, which we just saw after last week. So that's why we're kind of seeing this, at least in the news, a bit more. And it can move stocks for sure, but when you have a million of them, they're not going to move stocks much at all, honestly, these days. However, on penny stocks, if you get a big name that upgrades a penny stock, and that is the news of the day, and it's a low float, it could run for sure. It could bring in momentum, and then it could just go off to the races. By no means am I saying that these don't have any effect on certain stocks. They definitely do. But it offers little value outside of what you can already be doing beforehand, and well before these targets even come out. Because these targets are going to come out after the earnings, after new data comes out, after more information. But you can do the research ahead of time. You could just listen to the earnings call. You could literally look at the earnings, read the press release, read through their financial statements all ahead of time to make your own decision. Not to mention, though, that you're going to get massive moves off of these earnings reactions anyway. So at the end of the day, these moves have already played out for the most part. A lot of these big moves have already played out. And now it's up to sentiment, it's up to the overall market direction to kind of guide things from here at the end of the day. So anyone could go ahead and find the information that you're going to find in many of these different price target upgrades, downgrades, this and that. So when it comes down to stocks, let's say like Amazon, like an Apple, like even like a Netflix, these are stocks that you can just simply sit back to yourself, look at the numbers, look at the reports, understand, okay, what's going on? We're seeing, for example, on Netflix, we're seeing a decline in the user base. Is that a good thing? Is that a bad thing? How are they going to innovate? And if you don't see that in 5 to 10 years, potentially, or you see a bigger risk, that means that Netflix on your list is going to be down here, and maybe an Amazon is going to be up here because you believe that Amazon will be able to innovate, or there won't be an issue of Amazon growth in the next 5 to 10 years, or a Tesla growth, or let's say an electric vehicle charging company that's growing, right? That's how you want to be going about your longer term investing. Don't get scared by upgrades, downgrades in the short term, and many of these targets are actually only just 12-month targets. However, many of them will never be hit and are completely unrealistic at the end of the day, or just simply don't make any sense. And one more final point to make, which is I think the biggest point when it comes to these price targets. These price targets get adjusted all the time, upside, upside, upside when the stocks are going up, and then down, down, down when the stocks are going down. This example of Amazon coming off the best ideas list is a perfect example of a stock that's been weak as of late, that comes off the best ideas list because it's been weak as of late, which could potentially offer some of the best returns for someone to buy in potentially right now if the market were to respond and bounce back. Whereas when you look at price targets after stuff's already been down a lot and they issue a downside target, there's so much less meat on the bone. When you're looking at stocks that have made massive moves up and these targets get adjusted up, 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 up like they've been the past couple of years, there's less and less and less meat on the bone. In the past 6 to 12 months, you've seen a lot of stocks reach that top and come right back off the downside. And if you're buying in after these targets have been released, most likely you're probably behind the curve anyway. So I encourage you to think ahead, and I wouldn't get too caught up in some of these price targets by any means. That's the video. Hope you got something out of the video. If you did, make sure to leave a like and a comment down below. Helps out the algorithm a ton. Any links, resources, good stuff in the description box like usual. We'll be going live Monday, Wednesday, Friday, and Sunday nights. Make sure to stay tuned, and I'll see you guys in the next one. Peace.